Ouch! Ouch, Charlie!
Anyway, Drew Meredith, welcome to this episode of the Australian Investors Podcast, 2 cents edition. How you going?
Pretty good. Good to be here as always.
As always.
A sunny Friday in Melbourne.
It's very sunny with a lot of rain and no sun. So good day. Why don't we, for folks that are watching, we're going to play a disclaimer for everyone. It goes for about 10 seconds. And yes, I'm wearing the same jumper. Here we go. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Today is a Friday, Drew. We are recording 10th of May. 10th of May, Friday. And it's, the weather's not
Mother's
great.
Day this weekend.
Mother's Day for every investor out there who has forgotten about their Mother's Day plans. Go and do that now. Hit pause.
Buy some stock.
Or multitask. Give them some Apple shares. No, don't do that. Actually, I think Apple's X growth, as we discussed last week. This fortnight, we will be in Melbourne for the ASA event, the Australian Shareholders Association. They are holding their conference, which is the Monday and Tuesday, off the top of my head,
21st and 22nd?
21st and 20th and 21st, I think. I think that...
Oh, Tuesday's the 21st, yeah.
Yes. The Sunday, which is the 19th, I'm hosting a value investor program in person at the ASA event, and then we have cocktail drinks afterwards. So get your tickets to the ASA upcoming annual conference on the Australian Shareholders Association website. That is my only bit of housekeeping for today, Drew. What have you been working on?
Working on a bit, just getting my eye back on the RBA board. A 2-day meeting with no result. It's always interesting where you can meet for 2 days and not change anything.
As in you're joining the RBA board? Is that what you were just saying? Or
just getting back laser-like focused on what's happening at the RBA.
Oh, yes. Yep. Fly on the wall, are you?
Just getting myself ready.
Yeah. And nothing changed.
2-day meeting and no change. Does it seem like 2 days is a lot of time for no change? I'm sure a lot of variables were discussed and a lot of biscuits and sparkling water.
Yes, there would have been sparkling water, I bet. But 2 days for no change is quite a bit of time just to not do anything. But that's basically what happens in this world these days. A lot of people don't have actual jobs. They just do meetings.
And not doing something can also be doing something. We know that. That is a decision.
Well, as Morgan Housel, the wonder, once told us that 99% of long-term investing is doing nothing. So sitting on your hands is probably pretty good. So what else has been happening?
There was some pretty interesting takeaways from that too. I'm not sure if you read the notes from the press conference.
No, I did not.
Markets bounced off the back of it. And I think like every Reserve Bank or central bank decision at the moment, people take it both positively and negatively.
Mm-hmm.
So they, on one hand, they said we think financial conditions are particularly restrictive on households, less restrictive on businesses. But I think one of the biggest ones was we don't think we necessarily have to tighten again, but we can't rule it out. If we have to, we will.
Interesting.
We don't think we have to, but we might, and we're not sure, is essentially the answer there. And the market took that as positive. I think they upgraded their inflation expectations to 3.8% for the year, up from 3.2%, but at the same time said we're unlikely to raise interest rates, probably.
There's a fair bit of people are going to be working out their jaw muscles over at the RBA for the rest
Imagine
of
if we used the word probably, like if you use this with just normal language and you had probably, maybe, we're not sure. Imagine how we'd go analysing that.
I can't find this. If anyone that's watching this live or if you're listening to this on the weekend, the Saturday morning, 7 a.m., 2 cents is the segment that you want. If you're listening to this or watching this, I once saw an online quiz that you could do where you get a bunch of adjectives. So it might be like, it could possibly happen. And then you would give it a score of whether you think it would happen, like based on the language, what you thought it meant, and the probability of an event occurring based on someone saying it's very possible. Because if someone says it's very possible, it means nothing. Exactly. Because it's possible, sure, but it doesn't matter if it says very or not.
No.
but people are manipulated by this type of information. And you basically did this online test, and it would give you a score of your interpretation of words and where your interpretation sat on a bell curve of what is generally accepted. If someone can find that quiz for me, I will give them a copy of Drew's new book, The Golden Years, 7 Steps for Anti-Aging. So please write into me, send me that quiz. I can't find it. It was an old investing blog that had created this, some software engineer from years ago, and I cannot find it to save my life. But I love that because the way we interpret language, Drew,
Give
has
2 books.
has a significant. Yes, we're going to save postage. I'll send you 2 books.
They talk about,
go for it.
yeah, they talk about Daniel Kahneman and the behavioral economics, or I think it's what's it not, financial psychology. I keep forgetting the word, but it actually is the shaping of questions that can determine your answer and what the alternatives are in a multiple choice, rather than what you actually think. And maybe how quizzes are shaped. And what you're saying is the way you interpret individual words. That the outcomes can be guided and influenced, not necessarily consciously.
Yeah, absolutely. It's I'll give you a good example of this week of this update. So this week we just passed the first month of Rask Invest launching. So that means
Credit to you.
Thank you, Squire. This month we have 1 month of financial performance for Rask Invest, and performance went up on the website. It was negative. We happened to launch the portfolios at exactly the time that expectations of interest rates changed.
And then changed again a week later.
Yeah, there wasn't much we could do about that for the first month, but it's all in the long term, Drew, 1 month down. But my point is that we went to put the performance for the first month on the website, because until we had a month, we didn't. It just said coming soon, right? And when the performance goes onto the website, typically when you see an investment return, typically you see it left to right. Like we read in the Western world left to right, and so we tend to anchor to the things that are on the left. So 1 month, 1 year, or 1 month, 1 quarter, 6 months, 1 year, 5 years, whatever. I wanted to reverse that because I knew that people are biased to whatever they read on the left-hand side. So we put since inception first. And this was an idea.
It's also 1 month, isn't it?
Well, yeah, since inception is actually 1 month. So it's a very long-term time horizon. But my point is, Simon Russell, who came on the shows from Behavioral Finance Australia, he did a survey with Livewire readers, and 400 Livewire readers took part in this, and they were presented with 2 funds that looked exactly the same. The only difference was that their performance was the other way around. And when people are presented with certain information, they will act just based on where it's positioned, let alone what it sounds like. And so this is like behavioral finance or behavioral economics in action. And so it's kind of crazy to me that people would make a decision based on adjectives or how words are dressed up or down. But it is what it is. What else? Before we move into questions, because I did want to get to a lot of questions this week, because we have a shed load of them and they're bloody great. So what else have you got for us?
Your favorite was in the news. Perpetual got taken over by KKR.
Who's my favorite?
I think Soulpats are a pretty big investor in Perpetual, aren't they?
Yes. Yeah. Yes.
So that was.
Well, I think it was the other way around. Wasn't it Perpetual that took Soulpats to court?
Yeah. And then they became a major share. Yeah, it's all so intertwined and confusing, as it always is.
Yeah, and your favorite would be KKR in this instance.
Well, they seem to be getting a deal because the share price plunged on the news.
There you go. What else?
Travel. I mean, you're still in the middle of confession season 2, aren't we?
Yes, we are.
So it's not quite come to an end. All the banks seem to be having a pretty solid. I mean, their profits are falling. Not that they go into losses. Their profits aren't growing as much as they did last year, but they've all announced at least a couple of $1 billion share buyback. So very much that US style. Unfortunately, because of the law change last year, you used to be able to do an off-market buyback where they gave shareholders and particularly retirees big franking credit refunds, but just traditional on-market share buybacks are all doing about $2 billion each. So generally that says either they think their business is overvalued or they've got nothing better to do with the money. is how that reads from an investor, and that's why their dividend yields are so high. But I think in most cases, they don't necessarily want to increase their dividend too much if this is, if they expect more difficulty to come in the future, because it's very difficult and you get punished quite heavily if you decrease your dividend in Australia anyway.
Yeah, you do. ANZ, good on them. And finally, any other news for us this week, Drew?
An interesting one I saw was still in listed markets. Well, there were two actually. One was that HMC Capital, so the group that took Masters out and helped float Chemist Warehouse,
Mhm.
announced they were basically launching a renewable energy strategy and targeting superannuation investors to get that started. So I thought that was quite a, we work in that sector a lot. We know a lot about it, and there's so much capital is needed and patient capital. So having a private equity kind of focus group like that was, I thought, super interesting.
Mm.
And then Bridgewater's in the news. I think we missed that last week.
Yeah.
They've had a difficult few years. So Bridgewater's like the best performing hedge fund of all time, having run for something like 50 years. Ray Dalio's left, essentially, still owns it. And they're changing his pure alpha strategy and looking for alpha again.
Oh, wow. It's I think Bridgewater must have been one of the first ones that combined something that people are familiar with another word of nature, like Bridgewater. I'm thinking like sandstone, and these types of names that finance people come up with for businesses. Speaking of words, that's what I often see a lot. It's like people who give us their wine tasting expertise. I feel like it just goes into just a random bunch of words and that comes out and it's like Bridgewater. Anyway, that's a bit of a rant for me, but I did want to get to a lot of questions this week because we didn't get to many last week. So we've had a flood of new questions come in, and we will obviously remind you that if you do send us your questions, please keep the names funny so we don't know who you are and because it makes us laugh. Second of all, try not to give us a full rundown of your personal finances and your history because we can only offer general financial information on this program. If you do want one-on-one advice or you want someone to give you an opinion on a financial service or investment or whatever that is specific to your needs, goals, or objectives, you will need to see a financial planner. You can head to the moneysmart.gov.au website to search for a financial planner, or there is a link in the show notes that says financial planning and you can get matched with someone that we know, or you can just email drew@wattlepartners.com.au. We may also refer to things like ETFs or super funds. They have product disclosure statements and TMDs. So please go and check them out.
What was I going to say? We enjoy it when you include our names in the questions as well. They are always well appreciated.
Yes, they are indeed. So the first question, actually, why don't we go straight to...
Owen is the goat. I like that.
Oh, yeah. So we'll go straight to Owen is the goat, which is very, very humbling. Thank you. When investing in the cash ETF by BetaShares, that is based on investing in term deposits, do you still have the safety net of the government $250,000 guarantee? Two things to explain here. BetaShares has the AAA cash ETF, which is the most popular cash ETF. All it does is takes your money and puts it in term deposits effectively. It pays an income stream once a month. Disclosure, BetaShares is a sponsor of our Australian Finance podcast. The second thing is the Australian government has a guarantee of $250,000 per person per ADI or bank. So basically what that means, if there's a run on the bank or the bank goes into liquidation for whatever reason, however unlikely that may be, the government steps in and says up to $250,000 per person, we'll guarantee that. And it's really important to understand that I use the language ADI, authorized deposit taking institution. So this would be an example of that would be like NAB.
Or Suncorp or...
Yeah, something like that. There's a list of them on the government website if you Google government guarantee list. But it's important to understand that banks like NAB can also have other brands that fall under its overall ADI status. So things like Ubank and those types of things, they may all fall under the same thing. So if you have $500,000 and you spread it across different brands, it may actually be under the same bank. So just keep that in mind. Now, what the BetaShares ETF does is it's a really good strategy for people who don't earn any interest in their bank account. They can put money into this ETF and have the money still in their brokerage account, but invested in the ETF and earning monthly interest. My understanding is you do not get the government guarantee because there is a limitation on that. And I think that thing's got, from the top of my head, I think it's got more than $1 billion invested in it. So I think it exceeds the cap, so to speak, Drew. That's my understanding.
Yeah, invest in money market and short-term securities. Yeah, definitely. Versus deposit products issued by authorized deposit-taking institutions.
Yeah,
and I think there's only 46 of them, or 23. It's 23 or 46. I can't remember exactly. But they're subject to. This is why they're subject to, and regulated directly by APRA,
Yep.
versus money market, which is just a part of an issue by those same banks at a different part of their balance sheet.
Yep. Okay. Worried Aunt writes in and says, how do I subtly help my 34-year-old nephew, who is a high earner but high spender with no assets and a huge credit card debt? He's been sold a house and land package with little deposit, then using his parents' house as guarantor. His parents are reluctant, and his house dream fell through. He doesn't know that I know about his situation.
It's like one of those calls on the radio.
It's like a love story, and how it's gonna help this person out. How do I direct him to your podcast?
Thank you. Do that. Yes.
and paying off debts and investing in ETFs. One of the things, I was just having a conversation about this, Worried Aunt, with someone, and one of the things that I've realized, having tried to do this for 10 years in my personal life, but also through thousands of people in our community, is that oftentimes the person who gives the advice is the roadblock. And so what I mean by that is, oftentimes you need to let someone convince themselves. It's like that old movie Focus with Will Smith in it. I think it might have Margaret Robbie in it. Could be wrong about that. Basically, you want to let them make the decision that they need to do it. And one of the ways you can do that is you can kind of just put the cues in front of them. You can talk about investing when you're around them. You can share stories that they might be interested in. Or you can put them in an environment that is conducive to them learning. So bring them along to events that we run throughout the country. We'll be running some events towards the end of this year, in the second half of this year, I should say. So there'll be events everywhere that you can bring them along to.
Drinks and food there.
Drinks and food, according to Drew. Drew's sponsoring. That's all on Drew. Drew said that, not me. But basically, you want to be able to connect with him on his level if you are trying to do this. So if he's interested in spending money, you could say to him something along the lines of, well, if he spends money, he's probably buying Nike shoes. Why don't you tell him that you own shares in Nike and you've owned shares for years and you made a shed load of money? And that might get him interested. That would get him more interested than trying to talk to him about Commonwealth Bank.
I think it's just not being afraid to say something, and it doesn't mean. I think most people won't take it kindly if you're telling them what to do or lecturing.
Yeah.
Is what you're saying. So how do you just become more aware and help him improve his financial literacy? I think is the main one, and things that resonate. Send YouTube links to Owen and I, maybe, or not. But there's plenty of other groups that are great at engaging different generations too.
Yeah, absolutely. There are like Equity Mates and that type of thing. If he's more on that level, the other thing to keep in mind would be maybe you can go to him for help. Ask him for help about something that you're researching or something that you're thinking of investing in, and get his opinion and see how he thinks about it, and let him think that he's the one giving you advice. When after all is said and done, Worried Aunt, you're the master manipulator that gets him to invest.
It's like Inception.
Yeah, that's it. Yeah, you're turning his mind in on itself, and see how he goes with that. But that is a wonderful question, and we have wonderful resources about like that are free courses, that sort of a thing. But the key for you is engaging with him on his level and getting him to invest something into that conversation. That's what you really want from this. Hola Gents says Spork 256 on YouTube. This could be a silly question, but I've heard you guys talking about yields of ETFs like IAF and VBond yielding 4 to 5%. The websites have them around 3%. What am I missing?
There's two different stories here, and this will roll out over time. I think we've discussed it as well. That the government bonds being bought that you're buying in these instruments are all yielding 4.5%. But the nature of trusts and ETFs is that if they realise losses in previous years, so for instance in 21 and 22 when interest rates went up and the fund was turned over, they will not necessarily be distributing all that income, the 4.5% income every quarter immediately as you buy it, but it will gravitate towards that as you hold it for longer. And that's why I think they're always longer term investments.
But there's also, correct me if I'm wrong, Drew, the difference between running yields and yield to maturity.
Yep. Yeah, exactly.
Yep. So there are different types of yield measures, Spork, that you will see. Things like trailing 12-month yield may be different to the new bonds that are coming into a fund, may be yielding more than the bonds that are still in there and will mature out in a couple of years.
Exactly.
And so that's kind of the yield to maturity figure, or YTD, is YTM, is a metric that tries to encapsulate that, Spork. It tries to encapsulate if the bonds are held that are in the portfolio, the income plus the capital component. So have a look at that. Some of the websites like iShares and Vanguard, they do have like a little tooltip. If you just hover over it, it will tell you what that metric actually means. So just keep an eye on that.
And a running yield only considers the last few payments.
Yep.
That also, it only considers usually the last 4 payments and averages them over the unit price. So if the most recent payment was higher than the previous 3, it's not reflected in the running yield that's being measured yet either.
Yep, good point. Cash Burner writes in and says, G'day, Owen and Drew. My question relates to hybrid securities, convertible notes. Oh, this is right down Drew's alley. What exactly are they? And are they considered to be speculative? Is this the type of investment only to sophisticated investors? The information presented to me suggests that this is an investment vehicle, pays interest quarterly over a 3-year period at a fixed rate of 15%. Love the banter, information, and education. And I will slip this in there. Dad joke. A boy asked his Bitcoin investing dad for 1 Bitcoin for his birthday. Dad says, what? $15,554? $14,354 is a lot of money. What do you need $16,782 for anyway?
To buy a new car.
I love that, Cash Burner. I love any question that takes the piss out of
it. Well, great. I'll send you a book. Send me your email. We'll send you another book.
Anyway, Drew, hybrid securities, what are they? Are they for institutional wholesale investors only?
As the name suggests, they're hybrid. So they're seen as being a portion of debt and equity. So they are technically part of both parts of the balance sheet, and they're hybrid or part of both because in most cases you get a interest payment, a coupon that's usually set at a level above the prevailing interest rate, whatever that happens to be. But in the absolute worst case, the issuer, a lot of the banks, could convert your in the instance they get into a lot of trouble, they could convert your hybrid securities into equity, and in that instance have the potential to lose a significant amount of capital in that instance. Generally, so we kind of see them as 2 different groups. Hybrid securities issued by banks. Banks are subject to capital adequacy reporting. Yeah, it's almost daily and monthly to APRA, and they're regulated by APRA. Whereas the rest of the industry, so they can be issued by anyone, but traditional normal companies that aren't regulated at the same level and don't have capital requirements would be the other issuers. So most of the banks I think they're paying something like 6 or 7%, and we've never seen a hybrid not be redeemed by a Big Four bank. In my history anyway. It may perhaps at some point in the future
not be redeemed.
Yeah, not be redeemed or replaced at some point. So basically, when they one of them came up recently, I think one of the CBA pearls came up where the cash was paid back. But in most cases, they'll raise a similar instrument, and you can roll your money into that one. It's a different case in the corporate world. So there are some, I think, back in the day, whether it's the timber plantations and those sort of groups issued some, and you're relying on not the capital, but basically the success of the business and the business staying in business to get your money back. It's like any loan essentially, but this one can convert into equity. Not just for sophisticated investors, but like anything, they have big PDSs and there are risks. We think for banks the risks aren't that much more than fixed income, and they're not quite at the same level as shares. But
so they do sit, in your opinion, they do sit between bonds and shares in terms of their risk.
Yeah, slightly above bonds, but nowhere near the risk of shares.
Interesting.
Yeah.
So there are some active strategies that you can use in Australia. There are some active strategies that you could use in Australia to get exposure to these. They're also wrapped up in an ETF format as well. So they do tend to yield a bit more. And Drew is right. The reason that they're called hybrids is because they
he pulls out the prospectus. Here we go.
Yeah, here's the prospectus for NAB Capital Note 7. It's 120 pages for those of you that are playing along at home. The thing is, they do have, for an investor's portfolio, they do have elements of a credit product in that they're going to pay you a set amount, typically floating, if I'm not mistaken, Drew. And then if something goes really wrong, they will then change into equity. And one of the common criticisms that I hear of them, Drew, is that you get bond-like returns with equity-like downside. Because I think it was NAB, wasn't it NAB during COVID that was forced to convert? Was it NAB? Or am I thinking something
No
else?
one's forced to convert. They just get. It's a matter of whether they can raise additional capital or whether they have the capital to pay it off. I mean, they did. So we recommended to our clients during the pandemic. A lot of them dropped. So they all issued $100 par value, and that's what they'll be repaid at. Some of them dropped to $80, $70, and $80 for about 4 days. And one of our recommendations was to buy it at $70, $80, and it quickly returned to 100 shortly after. Not suggesting that's a strategy at the moment. So they're listed, so they can trade, and when it looks like banks are in trouble at some level, they can move significantly. I think the key is, and this is why the government doesn't guarantee these; it guarantees the bank's deposits with the bank. But in our view, the kind of risk reward is tilted in the reward side for bank issued hybrids. But there's anything that has a 120-page product disclosure statement suggests it's pretty complex. One thing would be, from memory, the conversion level is if a bank's capital falls below 8%. So that makes sense. Like in Silicon Valley Bank, then hybrid securities would have been converted to equity, and you would have had your equity wiped out. But Silicon Valley Bank isn't subject to the same. I'm guessing that was the case. I'm not 100% sure, but Silicon Valley Bank is not the same as the National Australia Bank or Commonwealth Bank. So their capital would have to fall from something like 12.5% to 8% by a third, which means everything, that's a massive amount of defaults and all that sort of stuff in their own balance sheet before these would be impacted.
Yeah.
That's getting to the complex level, probably.
Let's go deeper. So one of the reasons that I think that Silicon Valley Bank ended up the way it ended up was because it had long dated bonds and some of the assets that were liquid. So some of y'all will remember this, but when interest rates start going up, bond prices start going down, which when you are a bank and you're backing your balance sheet with those assets that are going down and people are needing the money, it's not a good recipe.
Yeah.
Drew son, I do have a screenshot here from NAB Capital Notes.
Really put me to test, yeah.
NAB Capital Notes, formerly listed under the ticker code NABPC, were resold on 23rd of March 2020. It goes on to say, on this day, all NAB Capital Notes on issue were mandatorily purchased for $100 per NAB Capital Note, and a final distribution was paid. So basically, it was not good times for these holders, and they got mandatorily repurchased or converted. And
they do have a maturity date, and they have two maturity dates. They have an early and then an actual maturity date where the bank can call them. And a lot of it is to do, like, these are just funding instruments for a bank. So yes, they can be expensive funding if they're at 6 or 7%, and banks try and issue them or redeem them to suit them and keep the cost of capital low.
Yeah, and then the second thing, just to tail on the end of that is the thing that happens is the banks, like the Australian banks, like to use these because they have capital requirements. So the reason that they exist is not just because the banks want to pay you extra money. It's because they use them and put them on their balance sheet so they can meet regulations, which help them. And that's why I always get a little bit spooked about 120-page prospectuses of financial jargon that I even struggle to understand. But if in Drew's case, I think he's spot on in that you can use them tactically as long as you're aware of the risks. There are some fund managers in Australia who have very strong opinions of property prices, yet have very expensive underperforming hybrid funds. And so I'll leave you guys to figure out what I'm talking about. Just don't be fooled into thinking that it is a perfect solution. Everything, like, there's still a need for bonds in your portfolio and all of that type of thing. Warren Wilcox,
we're even struggling to get through all these questions. We're only doing questions.
Writes in and he says, in the YouTube chat, g'day Warren, I can bring that up on the screen there for anyone that's watching over on LinkedIn or Twitter. Hi guys, I have a question about the prices of ETFs listed on the ASX. The price appears to include unrealized gains. Is there a way to determine the value of unrealized gains in the price of the ETF, Drew? What's an unrealized gain?
An unrealized gain is when your ETF is holding stocks that have increased in value since they purchased it. So the cost base, the value is up above what the cost base was, and it's natural. That's the inherent nature of any trust structure. So managed funds and ETFs are very similar structures. That you're buying those assets that have been put together in there. What the issue can be is that if you, and this is exactly the case for managed funds as well, that if you were to buy in June, say early June, and the fund had sold a lot of realized capital gains, it sold a lot of stock during the year, even if it wasn't while you held it, you will get a distribution that will probably be full of capital gains at the end of that month, because the end of financial year is when they have to distribute. Trusts have to distribute all profit and gains every year. So you're buying the pool more so for a fund of unrealized gains and the cost base in there.
And this tends to happen with ETFs that go up a lot. And
the S&P 500.
Yeah. Shadow D on YouTube says Fallout is the best game around. Only just joined and was confused at the thumbnail. So for those of you that aren't watching on YouTube, I did use the Fallout. Fallout is in the title because we do have a question about this, which we'll serve up next, Shadow D, for you if you very much like. We are talking about investing. We've probably got a few gamers. I am a very passionate Fallout gamer myself, so you're in the right place, mate. We're just talking about investing. Anyway, so where was I? Realized gains, unrealized gains. Typically, what you'll find is that for ETFs that have concentrated portfolios and are typically focused on things like stocks, those portfolios tend to have the most jagged July 1st. So what I mean by that is they're the ones that tend to build up those gains inside them and then release them. And then on July 1st, if that's a trading day, you will see the price of the ETF fall significantly, but what you're going to get is a distribution.
I've had clients for 20 years that still are surprised when why is my holding falling 10%?
Well, it kind of doesn't make a lot of sense to someone that's not a finance person. Like, why would it just not be still in there, kind of thing? It doesn't make a lot of sense.
And why doesn't the cash come out straight away?
Yeah, it's like people associate it with like BHP shares. BHP doesn't fall on July 1st just because it's a new financial year. So that's one of the things that happens. So I will quickly then jump across, and we can come back to Hooly Dooly's comment in a little bit. But in the title, we do say something about Fallout. So another Vault survivor writes in and says, and this is for people that have watched the Fallout show on Amazon. It's a new series out on Amazon. Quite gory. Don't show your 10-year-old kid this show. Also, it's a great flick. It gets about 93% on Rotten Tomatoes. So high conviction buy from me. But also, it's a video game, and the video games, I reckon, even better. So a very topical question for Owen. I've just listened to the latest Australian Investors podcast and hope you can share your thoughts on what you would do. I understand that any comments are purely for entertainment purposes only and do not constitute personal financial advice. I will soon be cryogenically frozen for 200 years, and I do not want my savings to sit idle in a term deposit during this time period. What are your thoughts on investing in Voltec shares? They look like an up-and-comer in the building industry with very robust constructions. Robco shares. Robert House has been making waves with robotic advancements that is highly interesting. Nuke Cola shares. Everyone loves Fizz, and Buffett bought Coke, so this could be a safe bet. An alternative, this is D, an alternative diversified apocalypse-focused ETF, such as BetaShares Atom, Vanguard's Boom, or iShares Nuke. Really appreciate any general thoughts that you can give or access to a course. So this person has clearly written in to get access to a free course and possibly one of your books, Drew, which is fair enough in my opinion. But I want to give a question. I'm going to throw something to you. If we are going into like a post-apocalyptic world, would you buy Coca-Cola shares?
No.
Why not?
I don't even think money. It's gold. It's got to be gold.
It's got to be gold.
The only thing you would ever hold is gold.
Well,
maybe baked beans.
Baked beans, shotguns,
or actual cans of Coke.
Yeah. Okay, cool. And would you buy Coca-Cola shares anyway?
I'm not the most growth-focused investor, but it feels a bit mature for me. And finding new verticals for Coke and moving the dial for Coke is very good, very hard. Mm-hmm. So I'm probably a no on Coke.
Okay. Would you buy I'll give you a, how we like to play games here on the show. Over the last 5 years, I'm going to ask you a hypothetical. You know how we like to play over and under on the show?
Oh, yep. Here we go.
Okay. Over the last 5 years, not including dividends, Pepsi or Coke?
Coke.
As in Pepsi, the company.
Yeah.
Pepsi has won 39% return versus Coca-Cola at 31%.
So it's only 6% per annum. Mature, but not too bad. 6%.
Okay. What about this?
What's driven Pepsi? Clearly not the taste. Sorry, Pepsi.
Pepsi Max. Pepsi
Max making a comeback. KFC.
Okay, so here we go. Since 1984, which is where the data goes back to on Google Finance for PepsiCo, since 1984, no dividends, just the stock price. Pepsi or Coke?
Coke.
Pepsi. 7,700% return.
They make it sound like Coke's winning everything.
Versus a mediocre Coca-Cola 5,300% return, not including dividends. So obviously the Coca-Cola company listed on the New York Stock Exchange, KO is the ticker symbol. It's a wonderful business, gross margin of about 60%, return on invested capital of 18%, even as a mature business, Drew. It's a kind of a distribution business masquerading as a soft drinks business. It's all in the brand. Warren Buffett's one of the biggest shareholders in the company through Berkshire Hathaway. The company currently trades on a price earnings ratio of 22 times. If Coca-Cola is 22 times, Drew, dividend yield of 3%, what would it need to get to for you to be interested? So Coca-Cola, 22 times earnings, 3% dividend yield. When would you need to buy it? Like what yield would you need to buy a business like Coca-Cola?
I feel like it doesn't make sense because in the US, but I feel like a yield of more like 5, and maybe a PE under 20. I know you're paying for a pretty big brand there, and you're paying for 38% market share in the US versus 18 for Pepsi. But tastes change somewhat. I reckon you need a yield of 5 because it's hard to see. If you think you want at least 10% return from any kind of stock holding, and if you've got 6% per annum from this over the past, you want to at least be getting 4 or 5 from dividends over the next.
Well, diluted earnings per share in terms of their change in recent years. So the earnings per share, if I go backwards in years for Coca-Cola, was 13%, negative 3%, 25%, negative 13%, 38%. So you're getting growth, but it's a lot of accounting mumbo jumbo that goes in there. Dividends per share have been resilient and growing for the last 10 years. In fact, for the last 20 years, the dividend from Mr. Dividend Investor himself, Warren Buffett, he'll be very happy about this, has been very, very resilient. But as you say, still dominating Pepsi, even if Pepsi's share price is on the up.
Sorry, Pepsi.
But that was a good question. And I think the questions out of that were...
Pepsi does own Doritos, though, so let's just put it down to that.
There you go. So Nuke-Cola shares is just the fallout equivalent of Coca-Cola. I think it's a good business. I think you just got to buy it at the right price and be aware that it's not necessarily the growing business that it once was. That says it still has pricing power. As for ETFs focus on nuclear energy, to be honest, I think the one thing that I've seen with nuclear or these types of related themes, if people want to play them, is what I've found is that a lot of people have said uranium for a very, very long time. And then they said, Fukushima disaster, they said, the Fukushima, if it wasn't for that, things would have been okay. But still, we're seeing it's still a commodity play, in my opinion, and it still requires a lot of political will to get that over the line, Drew.
Yeah, it's something that pops up every couple of years or so, and in some cases it probably makes sense. And this can be a lightning rod, so it's very difficult to pick a side. I'm kind of, what's the point of nuclear? And I'm sure the people who like nuclear, if you have nuclear in place and it's operating, then yeah, completely it makes sense. But building new is extremely expensive. And I don't know, the play on a commodity suggests you need more demand for it, not just the current level of demand, but more on top of it. I find that kind of a struggle from a cyclical perspective, unless something significantly changed. And I'm sure we're going to get so much feedback about nuclear.
Chuck it in your satellite allocation is basically what we would be saying. Is chuck it in the smaller component
Yeah.
of your portfolio.
Position sizing matters.
Yeah, because as you said, in any commodity related business, you've got to be there for a good time, not necessarily a long time. Because if the commodity is abundant, the cost of production won't be that high, and the demand, unless it's infinite, will always be able to catch up to supply, and you'll find the market in equilibrium. And basically, what that means is the economics of those types of commodity groups don't make a lot of sense. A good one of that is we had BHP's former CFO on the show not too long ago, and he said that the reason that BHP never moved into lithium was because lithium is an incredibly abundant resource. Yeah, sure, it's going into batteries. Everyone will need it, but it's everywhere.
Yeah.
So you need to find a commodity that is in limited supply, but also has genuine demand. And the key phrase there is genuine demand, not a gonna happen, but is already happening.
Copper's a perfect example at the moment.
Copper. It should probably be in shortfall by the end of the decade.
Yeah.
Hooly Dooly in the comments
Holy dooly. Had to take that name.
says, could we get an everyman's breakdown of the difference between senior and subordinated debt and the risk profiles? Drew.
You're really throwing the good ones at me today, aren't you? I mean, it's quite straight. I mean, it's quite straightforward. It depends. I'm just trying to make some space here. So there's two parts of a company balance sheet. There's debt and there's equity. Equity is shares, and you can have preferred shares and you can have normal ordinary shares, and you can have a whole heap of other shares: A class, B class, controlling shares, non-voting shares. I'm just trying to change the subject. Debt is very similar, and there's multiple levels of debt. It starts at the highest, which is senior, and that is senior means they're the highest ranking. They'll be the first to repay if the company has issues.
We've spoken about senior secured loans on the show before.
And senior and secured means they're generally secured by specific assets, if not the assets of the company. And as it goes down, then subordinated comes quite quickly afterwards, and then it goes down to all the way to the bottom, which is something like mezzanine, which isn't really it's secured very broadly and not specifically. So if you're invested in a company, if you own the bonds in a company, or if you own the shares in a company and it went bankrupt, they sell all their assets. The senior bondholder will be repaid first from whatever was there. If there was only enough to pay all their money back, they get the money, and everyone else would miss out, in the most simple explanation. If there's more than enough, then it would then go to subordinated, and at the end, equity holders would have whatever's left over.
Well said, Drew.
Oh, good, I did it.
So if we look at the sub D ETF, which was Holy Dooly referred to, it would have to be HOO for Hooly Dooly, wouldn't it? Maybe I'm mistaken. So anyway, if we look at the sub D ETF, which is the VanEck Australian Subordinated Debt ETF, which I've talked about quite a bit lately, and I think you might have talked about it. So if we look here, we can see in the holdings that it's got 27 holdings inside of it. We said like earlier this week or last week or something that it returned about 7% over the past year, but about 6% of that return came from income, which is what you'd expect from a debt type product. But you can see here in the list of things that it holds, it's got CommBank debt, BBB plus, it's got National Australia Bank BBB plus, and you can go down to Westpac is A minus. I don't know how Westpac anything gets a higher rating, but anyway. You can go down the list. It's a bunch of bank debt. You got QBE right down the bottom. You got Macquarie, Suncorp. What else you got in here? Other.
It's a triple B rating for a bank that's actually rated A as a bank, but this issue is rated triple B.
Yeah. And you can see, what was the other one? HSBC was in there somewhere, I think. Yeah, HSBC. So this is basically what you see in the portfolio, and this composite ranking is basically a credit rating. It's a credit rating. And typically what Drew was referring to is called the waterfall. It's like if there was a company that went bankrupt, it would go down the waterfall. It would start at the top, the secured, the senior secured, and then all the way down that waterfall, the different levels of debt that has been issued will get repaid. And they get different ratings depending on that. And so what you see here is subordinated debt. It's not saying it's a senior secured loan. It's obviously something below that. And you can see the different ratings of the instruments inside it. So that's basically how it works. Is like you need to know where you are on that risk spectrum. And for anyone watching, I'll see if I've got a credit default table that I can quickly bring up. Or let's have a look. Is it this one right here? Okay, yeah. So in this table that's shown on the screen, I'll try and walk everyone through it that's listening. This is from a First Licks article published ages ago. It's using S&P data from 2022. And it shows the global corporate average cumulative default rates. In other words, you can see all of the different levels of debt down the left-hand side, AAA at the top being the most reliable, and then all the way down to speculative down the left-hand side, as well as the time horizon. And you can see the default rates at that particular level. So you can see if you've got a BBB
Still
rating,
very low.
it's a 1.4% default rate. Very, very low default rate. And so this is what you can see. But then if you go down to CCC, which is basically if some debt gets CCC, you know it's about to blow up. 47% default rate. And that's how we can see how the industry tries to grade different types of debt. And the further you go down, the more likely you are to get a default, but the higher the yield that you would expect from each individual thing that you're invested in. I know that's not an everyman's definition. That's probably more a technical definition, but just think lower rating, higher yield. And that's basically it, Drew. So
yeah, exactly.
Thank you for the question. We've probably got time for one or two more. Get your dad joke ready, Drew. So, okay, here we go. Pennywise the Clown says, if you were to receive a large windfall of $1 to $2 million bucks, how would you dollar cost average into a core portfolio of ETFs over a few weeks, months, year? And what would you do with the cash while you were waiting for your next buy interval? So basically, we do have a lot of people writing into us lately saying that they do have $500,000. They have $1 million. They're looking to invest it. They're looking to invest in ETFs in particular. How do you go about it? And it's a different case for people that are looking to build a diversified portfolio. Like if you want a ETF portfolio, stocks and bonds and cash and this and that, it's a very different type of answer, I think, than if you're trying to buy individual stocks. Drew, what do you think?
Yeah, I think we have this question all the time, and it depends on. I mean, in this case, it sounds like it's coming straight from cash, whereas a lot of the time we say might do a rollover from another super fund that's fully invested, and it's like if you go from fully invested to then slowly stepping in, that doesn't make sense. And to us, you want to be buying a diverse portfolio and just putting it all in at the same time. In these cases, I think depending on the breadth of what you're buying, you'd probably want to do it over a period of at least a year. If you've got significant breadth, so if you're just buying like 5 ETFs, then you definitely want to step that out over a longer period of time. But if you're building a more diversified portfolio and there's some core and satellite, I think you've got the ability to execute it quicker, assuming you're putting into a broad range of asset classes and investments.
Yeah, fair. I like it. And I think that we've spoken about this before. I think it's only if you start trying to buy a $1 million trade of a single ETF at a single price that you'll probably get your trade rejected. Yeah. So you'd break it up. You'd want to maybe put it into tens of thousands or hundreds of thousands if you're that way inclined. We get this question a lot because of people wanting to invest with us, and you just make a purchase and get comfortable with it. So Double Dagger Plus. A Bubble Dagger Plus?
We've got a cracking dad joke.
Okay, we'll get it for you in just a moment. So Bubble Dagger Plus, I think, I don't know, it's like half the time I don't know if people are writing in and they're just got the fat finger syndrome and they're just like pressing the different keys, or if they're actually doing this on purpose just to try and bamboozle us. So they're talking about Vanguard, Super Industry, Super Self-Managed, etc. Says, who does OE have his super with, and who would Lord Sir Professor Dr. Andrew Derrimouth Esquire PhD LTD put his with? P.S. I have recently purchased glasses and plan on leaning to read. I hear the golden years is easily
yes, another book. Marg, the office manager in here we've got 500 copies of the book under our desks, and she's like, yeah, just keep. We need to send more out.
Drew at wattlepartners.com.au. So Bubble Dagger Plus. I've said this before. I have my super with Australian Super, but in the options that I choose to invest in. So I go in and I mix my own. But in the future, I will have an SMSF. I'm probably not that far away from it, to be honest. I just, being self-employed for a very long time, I didn't pay myself super. So it doesn't really justify it yet, but it will in the future. Drew, care to comment?
Mine's an SMSF. It kind of is a bit mixed, but core satellite. So some ETFs and satellite-ish managed funds, and then some direct stocks when I get crazy ideas from this podcast.
Yeah, we get some. Watch him go and buy Doritos / Pepsi.
I always think I probably don't. Yeah,
Next
let's
week.
not talk about my investment philosophy. But I think, and we do this for clients all the time. So as part of every strategy, every time we meet a client, we'll do a financial plan for them, and a big part is picking the right super fund. And all of them are appropriate for different types of people. So an SMSF is great if you want control, and you've got a large balance, and the fees are fixed. But that said, platforms like Hub24, CFS are incredibly good, much better than they were 15, 20 years ago, and they can replicate a lot of what an SMSF does. And then industry funds are great for insurance and smaller balances, and their returns, like the returns you can generate, are based on what investments you choose for each one anyway. So it's not there's one better than the other. There's just one more suited to each person.
Yeah, fair enough. There was a good question that came in from Kanye West, Australia. Kanye, you did write in and you said, I ain't saying Global X are gold diggers, but they are show sponsors, and they just launched a cheap gold bullion ETF. It's a 0.15% management fee, and they had the gold ETF, the most popular one, at 0.4. They both seem to invest in physical gold, so what's the difference? I will explain this in the community, Kanye West. So come over to the Rask community. You'll find a link in your show notes or below the video. I am exploring this for our investors at Rask Invest. So that's that. Finally, I do need to choose the best question to name this week. And I'm going to go with another Vault survivor who I did want to get to a few things around. What would a post-apocalypse portfolio look like? I'll get to that maybe in the coming weeks, but basically go and watch Fallout. It's on Amazon Prime, and design your portfolio as if it would survive all weathers. Not just any future, but all types of futures that may eventuate. I don't think we're going into a nuclear apocalypse, but may as well build your portfolio as if it's resilient anyway. Drew, you will send everyone a copy of your book, The Golden Years, How to Survive the Next Fallout. If they just write into you at drew@wattlepartners.com.au. And thank you to everyone like Holy Dooly, Warren, Shadow, everyone, Spork, that wrote in a question live on the show. Drew, you've got to take us off into the sunset with your banjo. You said it was a cracker.
I feel like this could be the best. All right. We all know about Murphy's Law.
Mm-hmm.
Anything that can go wrong will go wrong. But have you heard of Cole's Law? It's thinly sliced cabbage.
Well, I did read a worthwhile quote from Charlie Munger this week in the book Poor Charlie's Almanac. I did a quick review of that for our community, and it said in intense ideology should be avoided because it turns your mind to cabbage. So there we go. There's a bit of an investing anecdote for people that are interested.
8 out of 10. I'll take
Martin, you're giving Drew an 8 out of 10 for
Martin.
that. Rubbish.
Martin.
Christ.
I'll ride off into the sunset.
Yeah. Go and enjoy that, Drew. As always, mate, thank you. Absolute pleasure. Appreciate it.